All right, we have more changes unfolding in the U.S. economy and in the U.S. real estate market. Changes that include a record collapse in commercial real estate lending. This just happened. The last few weeks of the year, bank loans for multifamily real estate projects have fallen off a cliff. We have the numbers. We also look at the sudden surge in apartment supply that just hit the market. Are these two stories connected? We'll look at it. Also, we have new payroll numbers just released, and they spell some bad news for the American worker, for the middle class, and for the American dream, as it's becoming impossible in this current economy to go out and get a decent paying job. Wait till you see this. But before we get started, press the like button, subscribe, share the video with a friend. All of that helps out with the YouTube algorithm. U.S. commercial real estate loans, multifamily loans, have fallen off a cliff. We've been looking at how banks, particularly small banks, are tightening up their lending standards, making it more difficult for both businesses and real estate investors to secure financing, right? Only writing new loans for the most creditworthy of borrowers. Well, what just happened in the last few weeks of the year shows this phenomenon playing out in real time. You could see it on this chart. What we're looking at is year-over-year loan growth for multifamily commercial real estate loans getting obliterated. Now, part of the fall has to do with year-over-year, has to do with the year-over-year effect, but this is much more than that. Banks are making the decision to not write new loans. That's what this is, deciding to cut back and prepare for the wave of loan maturities that began 6 days ago on January 1, where a whole slew of CRE loans are maturing this year, almost 3 times the number that we saw in 2023. Now, in another story, we have financial media celebrating the sudden surge in new apartment supply. You can see it on this chart, writing how with the housing affordability crisis that Americans are dealing with right now, there may be a glimmer of hope, they say, as apartment supply just spiked, and could mean that renters will now be able to renegotiate their lease agreements with a bit of leverage, they say. But is that what you want? Is that what Americans want? Do you want to renegotiate your lease agreement, or do you want to buy a house? The rent-to-buy ratio is already completely lopsided, upside down. We could see it on this map. Red means it's cheaper to rent a house than to buy a house in that specific county. Well, what do you notice? The entire country, more or less, is red. Rewind a few years ago to 2019, and it was the reverse. Much of the country, was green, meaning it was cheaper to buy than to rent, as buying a house should always be equal or less than the cost to rent. Well, not anymore. Not right now. We have such a vast disparity in the rent-to-buy ratio where we're talking 50, 60, hell, sometimes even 80, 90% more expensive to buy than to rent. Take Jefferson County, Colorado. Look at this. A typical rental there costs $2,100 per month, but buying your typical Jefferson County home costs $4,300 per month. That's with your mortgage, property tax, and insurance. That means buying a house here is 107% more expensive than renting one, leaving you with a $2,200 deficit. And one of the only areas that you'll see on this map in the entire country that's in what I call the green zone is southeastern New Mexico, like Roswell. And unfortunately, not many people are jumping to move to Roswell, New Mexico. No offense to Roswell. Nevertheless, rent inflation is finally beginning to fall. We've been hearing about how rents will start falling for over a year. Well, it looks like that time has come, and with the huge supply of new multifamily properties that just hit the market last month, it means the disparity between renting and buying will only continue to grow, at least for the time being. In another story, U.S. bankruptcies jumped by 18% in 2023 due to higher rates and tighter lending standards. This is overall bankruptcies, though, for both businesses and for households. The total year-end figure came to 445,000 total bankruptcies for 2023 versus 378,000 in 2022. But if we zoom in and look at commercial bankruptcies, commercial Chapter 11 bankruptcy filings, they shot up by 72% last year in 2023. That's one hell of a jump, folks. We went from 3,800 in 2022 to 6,500, 6,600 in 2023. And they're expected to continue to increase bigly this year again as the number of corporate loan maturities more than doubles. And between higher rates and banks no longer dishing out money to just anybody, many businesses are finding it almost impossible to secure a loan. We played a clip from the Epic Times a few videos ago where they interviewed a small business owner, actually multiple small business owners in San Francisco, who they say are calling out for help because their loans are resetting in the coming weeks and no bank will touch them. Even though they say that they have pristine credit, profitable businesses, and collateral to offer, the banks just don't want to lend at the moment. In case you missed it, watch this.
We're recovering really well. We'll be within probably 30% of pre-pandemic numbers by the end of the year. So the business is doing well. The business is healthy, great reputation. And yet nobody will give me a loan on the building. And the one person that did make me the loan offer, the rate was so high and the terms were so bad. I mean, I was grateful to get the offer, but I would be out of business in 6-7 months because the interest is so high. It's an interest-only loan, and my payments would more than double, almost triple from what they are now. And so it would take, well, right now I'm doing what, $800,000 a year in revenue, and it would take most of that revenue just to make the building payments. I wouldn't be able to pay my staff, my vendors, anything. So, the interest rates are high. Nobody wants to make a reasonable loan, despite the fact that I have impeccable credit and a really good business and a lot of equity in the building. But it's like they don't care about those things that they've always cared about anymore. So I'm a little bit lost as to what to do, and I'm running out of time.
Now, Mark, a lot of people are in the same shoes as you are.
Yeah.
There's
worse, I'm sure.
$2 billion of loans coming due this year, and then there's another $2 billion that they need to get refinanced next year in San Francisco.
Yeah.
In another story, now that the first week of 2024 is behind us, betting markets still have high confidence that the Fed will be cutting sooner than later, with a 62% chance that the first Fed cut will come in March and a 40% chance that the first cut comes in May of this year. Only 1.6% think the first cut will come in July. And it's not just one cut that the markets are betting on here. They're putting their money on the Fed unwinding much of their tightening in just a matter of a couple of months. Look at this, over 40% odds that by July of this year, just 6 months away, the Fed will cut 150 basis points. Now, if that is in fact what happens, that means they are cutting to save the economy, just like what's happened every other time the Fed's done this. They begin cutting before unemployment spikes. Which brings us to our next story, the catastrophic jobs report that we just saw on Friday, a jobs report that the media hailed as a success, saying that job growth held steady. But did it really? Well, here's what the BLS said in their release. Total non-farm payroll employment increased by 216,000 in December, and the unemployment rate was unchanged at 3.7%. Now, on the surface, those headline numbers look good, surprisingly good, considering the Fed's about to cut rates. But when you lift the hood and take a closer look, things take an ugly turn, as the household survey, the far more accurate of the two surveys, show that the number of employed workers collapsed last month by an eye-popping 683,000, the largest drop since the pandemic. But it gets even worse. Something that you won't hear about in financial media or from the Biden administration or from the many economic sycophants on YouTube is how the BLS reported that in December, the number of full-time jobs collapsed by 1.53 million, bringing the total number of total full-time jobs to just 133.2 million. That's the largest monthly drop since the pandemic. Just think about that for a minute. 1.5 million full-time jobs just disappeared. Well, if that's the case, then shouldn't the unemployment rate have jumped? Well, it would have, but those workers who lost their full-time jobs went out and found a part-time job, balancing it out. We've been seeing this phenomenon play out over the last year. Full-time jobs continue disappearing, and workers are being forced to get multiple jobs, multiple part-time jobs to get by. A far stretch from what is considered a strong economy, and even a further stretch from what you'd consider to be the American dream. Could this be, by the way, what Jerome Powell and the other Fed members are seeing behind the scenes? They get first crack at all this government data. Is this at least partly why rate cuts are suddenly so urgent? Well, it could be, as the labor market is fickle. Once it breaks, there's no quick fix. All right, that wraps up this episode. Press the like button, subscribe. I'll see you next time.